Good morning, everybody, and welcome to today's bi-weekly podcast. It is great to have you here with us. These are some of our favorite things that we love to do with you is to offer some education, offer some perspective on what's happening in the markets, what's happening with planning, what's happening with the idea. Today is going to be a really, really important topic. It's really the crux of how we help structure things with you when it comes to your investments. So we're talking about risk versus reward today. But we're also talking about portfolio diversification. So this is going to be a great talk today. We have a lot of information for you, a lot of important information to go through because this is how it all comes together. So when some of the people that you don't really know on the team, like a Ryan, Mike, you start to know these people more and more, but they're a little bit more behind the scenes. They're scouring the investments, they're scouring the portfolio to make sure that what you own currently is what we tend to believe is the best thing for your retirement and your future to make sure that your money grows and is there for income purposes and other purposes that we're trying to accomplish together. So it's a really important topic today. I hope that you tune in. I hope you stay the whole time because we're going to have a lot of information from the team today. So also want to say we always start out with being grateful. Right now, I know Chris Doty, our leader, he's in Canada right now. He is at the Global Top Advisor Summit there. He's with some of the best minds in the financial planning industry. And what he's learning is something that will even help us better, help you out even more than what we're already doing. So we can't wait to hear the download when he gets back to the States from Canada and to see what other things that we can help implement here to ultimately give you the best outcome that we possibly can have. So we're excited about that. So what I'm grateful for is I think spring may have sprung. I'm not quite sure, but it feels like it. The grass is getting a little greener. We're getting ready to do the plantings. We're getting ready to do the seeds and the growing right now, right, for the annuals. And so hopefully it's a time where everything comes alive again, right? Like things start to look alive again. And I'm really grateful this time of year. It's really fun to be part of. And like, again, you kind of get excited for what's coming because summer's coming, the warm weather's coming, the family traditions that we all do, all fun stuff. Really grateful for that. Ashley, how about yourself?
Thank you, Ken. I am too grateful for the sun shining, the grass. I have a couple of bulbs that are popping up in our mulch beds. So it's just great to see the spring come and also brings a very busy time of the year with sports. So just enjoying getting outside more and playing with our kiddos at this moment. So thank you.
Fun stuff, Ashley. Fun stuff. Zach DeBoer, how about yourself?
Yeah, thank you, Ken. Probably sound like a broken record at this point, but extremely grateful for the growth and development of our son. He'll be 4 month old next week, Tuesday already, and it's just every single day there's something new. But also just extremely grateful for what we get to do on a daily basis. Serving you, going through these type of things, meeting one-on-one is my purpose and my passion, and I am excited every single day I get to wake up and do that with you. So just extremely grateful for the honor to serve each of you and each of our clients.
Very good, Zach. I think a lot of us echo that same sentiment as well. We love the one-on-one meetings. We love the conversations. We love all that stuff that we do with you. Thank you very much. Appreciate that. Mike Mann, how about yourself?
Thanks, Ken. Grateful for a lot of things, like you and Ashley. But not just grateful, I'm actually living it, being outside right now in the sunshine in the springtime. So no, that's wonderful. But truly, I'm grateful for my dad and my mom. I mean, it's just the time that I get to spend in Wisconsin and this time now that I get to spend extra moments with them at this point in their lives. And also specifically for the fact that they can let me use their vehicle when mine's in the shop. So thankful for my dad for being able to take me to pick that up this morning, and we're back in business. So appreciate them.
Thank you, Mike. Once a parent, always a parent. That's what they say. So no matter how old we are, once a parent, always a parent. So yes, thank you for that. Mike is in our Gentian Globe right now outside. So that looks pretty comfy and cozy in there as well. He's not in a tree stand. He's not doing anything like that. He's actually on a bench in the Gentian Globe right now. So Ben Renicky, how about yourself?
Thanks, Ken. Yeah, I'm just grateful, kind of echoing what Ashley said, of just spring weather, being able to actually get outside and enjoy some of the sunshine that we're getting. It's slowly starting to feel like we're getting away from that winter. We all know that probably not the case. We're probably due for another, at least one more snow, as Wisconsin's known to do, but we're getting closer to that summer weather. So I'm just grateful for that.
Absolutely, Ben. Thank you very much. It's baseball season, right? So,
Eh, Full swing.
Michael Birschbach, how about yourself?
Thanks, Ken. My gratitude today goes out to different mentors and inspirations. I'm pretty grateful throughout life to be guided by great parents and different individuals, personally and professionally. As a team recently, we've been able to give that gift back through financial education and some different events that we've done. So just grateful for that today.
Yeah, very good, Michael. We appreciate that. Yeah, it's been nice to do some education for the community and have them consume that information. It's always fun to do that sort of stuff. So it's our way of giving back, if you will. It's one of the ways we give back. So great. I think that's everybody that I covered today that I can see here from the team member. Again, we love to hear what your gratitude statements are. We love to hear what you're thankful for as well. We typically do that when we have our birthday lunches, our workshops we do, and also our one-on-one meetings. So thank you all for being you. We appreciate your story. So today we're going to talk about diversification. I'm actually going to share my screen. We're going to kick it off with a bit of a comic here. I like to do these. I know Chris loves his dad jokes. I've kind of come to these comics, and what you can see here on your screen is there's a rooster and there's a hen, and she is saying, "How many times have I told you not to put all the children in one basket?" I thought that was kind of funny. So we're going to talk about not putting all your eggs in one basket today. We're going to talk about, you've heard that before, but we're going to talk about truly portfolio diversification. We're also going to talk about account diversification. Those are two different things. We're going to talk about a little bit of the bucketing approach that goes on with when we get ready for retirement, when we're getting ready for that next stage, the starting line, if you will. It's not the end line, it's the starting line to a whole new journey. How do we go about structuring that for you? What changes? What really goes on that we tend to do for you? So it's the bucketing approach, but it also can be a risk reward, a bit of a shift, not a big shift typically, but a bit of a shift there, as we'll talk about that as well. So then we also have some planning ideas that we've heard recently as well. So let's kick it off. Let's talk a little bit about the markets as usual, Zach. I know we're going to touch briefly on that because it is part of diversification, because we're seeing different asset classes do different things right now in this uneasy time that we're in with political and tariffs and everything that's going on, that's causing the markets to be a little uneasy at this point in time. Zach, what do you have for us?
Yeah, thank you, Ken. Really appreciate it. I'll talk a little bit about markets, the reduction of risk with rebalancing within the portfolio, but then I'm also going to just touch on the risk of our overall plan. So not only the risk of investments and diversifying that, but also the risk of our plan itself. So starting with this, we just saw the extreme benefits of rebalancing that occurred last year, or really any time, but especially over the last year. And the benefit of active managed mutual funds. Times like these where markets are in temporary corrections or certain asset classes are underperforming, it's an amazing time for these managers to scoop up shares of companies that now they feel are a good price point to do that, where 6 months ago, 12 months ago, they may not have had that opportunity or it wasn't as attractive. So the benefit of active management is great during this time as well. So kind of touching on the different indices and where they're at currently for the year, the Dow Jones temporarily 5.4% temporarily down. The S&P 500 is 9% temporarily down on the year. The NASDAQ, which is 50% weighted towards technology, is 14. The Russell 2000, which is those smaller size companies, are 15.5 temporarily percent down. And this is to Ken's point of different asset classes actually doing really well to start the year. International is actually a 5.45% on the year, and emerging markets is relatively flat, less than 1% down. So, and then on top of that, our bonds are actually doing exactly what they're supposed to be doing during these times and are relatively flat, and a couple of them are actually positive on the year. So just amazing to look at there. The benefit of rebalancing with those and the reduction of risk is that those asset classes, the large cap growth, the small cap growth, those are ones that we've probably rebalanced out of last year. We trimmed off some of those gains. Your strategy in the large cap growth asset was probably one of your best performing assets within your strategy last year. We trimmed off of it. Most people make the mistake of looking at their best performer and go, oh my gosh, we got to put more money into that. It went up 50% last year, or whatever number it is. That is usually the worst time to add to that, where rebalancing trims off of it, adds to what didn't do as well, reduces risk, but because you're selling high and buying low, we've actually found it increases return over time as well. Just one real quick thing before I pass it back to Ken here is just the reduction of risk of our plan and kind of going through the best and worst days to show you that. So last 2 weeks ago, Thursday and Friday were two of the most down days over 2 days in market history. 3 days later on Wednesday, things did not look any better going into the day. Not one of us out there ourselves, clients in the world, thought that that was going to be one of the best days in the market over the last 17 years for the S&P, and the best day in the last 23 years for the NASDAQ. So I'm just going to show you one chart here, just the cost of missing the best days. I'll give it a second to pull up here. So if we look at this hypothetical growth of $1,000 over a 50-year time period, if we just let it go and didn't try to jump in and out of the markets, it'd be $121,000 over 50 years. If you miss the best performing day, just one day over 50 years of market trading, it was over a 10% miss on that. If you miss the 5 best days over 50 years, it was a 36% difference by just missing the 5% days. If you miss the best 15 days of trading over 50 years, it's a 64% difference. And if you miss the best 25 days, 1 month worth of trading, you would be 77% miss. That's where we talk about the risk of our plan. Nick Murray said it best in his most recent newsletter that we sent out to you guys, is that every single year, the most dangerous words we can say is this time is different to our overall plan. So with that, Ken, I'll pass it back to you.
Thank you, Zach. Really appreciate it right now. So also Nick Murray came out. We sent it out recently, like Zach is mentioning, and it really has it really brings it all together recently. So if you haven't read that one by Nick Murray, it's called Client's Corner. We send it out on a monthly basis. It says the market is inviting us to make the big mistake right now. Why? Because the markets are a little uneasy. They're temporarily down. You know that. We know that. This isn't the fun time of investing. This is the important time to be investing correctly and doing the great things that we're doing with rebalancing and buying low and looking at opportunities and Roth conversions. A lot of strategies go involved with all this. This is really a great time to be doing these things. But Nick Murray said it the best. It was really great. It said that the market is inviting us to make the big mistake. Do you know what the big mistake is? I can't hear you, of course, right? But it's selling at a low point. You never want to sell when the markets are going down, yet so many people tend to do it because they think it's, like Zach said, it's different this time. So Zach brings up a lot of good points. Also, when we talk about risk, because Zach is talking about risk, I want to add one point here, and then I'm going to bring Mike on for Mike's minute, is that when we think about the risks that we're taking in our investments in the strategies, right? So there's times where we can be more risky. There's times where we have to be less risky. But you look at a 25 to 35 year retirement, maybe even 40. Maybe Chris will talk about some longevity at our next technology workshop together, and how this might be a 50-year retirement, maybe a 60-year retirement. Who knows, right? A long time. The more conservative we get, the increase in risk of our retirement actually goes up. Because the more conservative we get, the less chance we have to grow our money over a longer period of time, and the less that it gives us, less money to make over time to provide income. So that's a really important piece here, is that we never want to go too conservative in times like these, or just in general, because we need the growth. We need it for income over time. And we know that the markets and great companies, they give us that great chance of earning more and more income to keep up with inflation that we're going through right now. So thank you, Zach. Really appreciate all the insight you offer there as well. Mike Mann, how about yourself?
Thanks, Ken. Yeah, no, I'm gonna echo a bunch of stuff that Zach kind of went through, and like the big thing that's uncertainty breeds volatility, and that's what we have right now. We have no idea what's going to come out in the news. We have no idea what's going to be said, and the markets are very reactive. They try to be proactive and trying to predict what's going to happen. Well, when they're trying to predict something unpredictable, what do you think happens? So we get the ups and downs, and that's why we have to own a lot of different things to be able to smooth out that ride and make sure something's available when money's needed. And the other thing that I want to talk about a little bit is Zach also alluded, Ken, you said it earlier about, kind of scouring what's going on behind the scenes, taking a look at what the opportunities are, what these things may be that our managers are doing that could be helping the portfolio itself, allowing us to just stick to the plan. And I want to just always reiterate, because I get emails and stuff like that. Is it time to change something? Am I in a good place? What do we need to do? We don't want to react to times like this. We want to plan for them. So sticking to that plan is doing something. And rest assured, our managers are making decisions behind the scenes to be able to help your plan stick to what we want to accomplish, which is your goals at the end of the day. Some of the things that we're doing later today, I am talking with a portfolio manager who's been featured in Wall Street Journal, Barron's, all these different areas. One of the top portfolio managers in the industry to talk about and get their opinions on what's happening, to see what changes we need to make, but to educate ourselves on how we can relay the information of what that fund is actually doing for our clients and to make sure that everything's going in the direction that we would like it to. And also just to understand, I mean, these people are brilliant. They're the ones who studied. This individual went to Stanford. She has her doctorate from there, all these different things. And to be able to speak directly with somebody like that so that we know that the investments are being focused on and giving us that information gives us the confidence that we can then focus upon the planning. So just because we might not be making changes, it doesn't mean we're not doing anything. We're behind the scenes. We're looking at things. We're making decisions and sticking to the plan. Remind yourself that is doing something. That plan is diversification. That's what your portfolio is built for, as Chris would say, come what may. Thanks, Ken.
Thank you, Mike. We appreciate your insight there and all the hard work you do behind the scenes with the portfolio managers. That might be a dream come true to talk to one of the top managers in the world, right?
I've been joking around about not meeting your heroes, and so we're going to see how that goes later today.
Yeah, maybe you have to get like an old stock certificate, get it signed or something by this lady. I mean, who knows, right? So
I'll have her sign my Zoom screen.
That's fantastic. So those are the things that we're doing for you when we're not meeting with you face to face. So we're always making sure that things are heading in the right direction. It's very much a plan based. It's evergreen. We built it for times like these, the good times, and also a little bit of the tougher times that we go through. So it's made for times like these. Which is a really beautiful thing. So let's bring on Michael Birschbach, see what Michael has to say today.
Thank you, Ken. I just want to hit on a couple of points of diversification and preparing for this. A few profound things that I found. Diversification eliminates between 70 and 80% of individual company risk. It's not rare for clients to work for one company that may offer stock options or equity compensation for a very long career where 20, 30, even more of a percentage of that is their net worth is actually built up in one individual stock, which there's some inherent risk built into that. But diversification, the concept really got popularized by modern portfolio theory, which Harry Markowitz came up with. And he actually won the Nobel Prize in Economics in 1990 for modern portfolio theory. So just want to share a chart that you may have seen from us before, but I think it's an important one just to revisit for us today. So I'll give that a moment to pull up. And what you're seeing here, the different colors are different asset classes or different investments that are indexes that are tracked that make up a diversified portfolio. All those different colors from top to bottom are showing year over year from 2009 all the way up through 2024 what the best performing class was that year. The really most important thing that I want you to take from this chart is that each year a different horse is leading the race. And that's why it's important to be diversified. If you look over some of the more recent years, going back to 2019, this light blue category, US large cap stocks, has been near the top, but there certainly is moments in tougher markets where we're not seeing that that's the case. So just wanted to point out that chart here for us today. But to reiterate what Ken had mentioned, not putting all your eggs in one basket. When you look at your investments, you may see 10 to 15 different funds. What's really going on under the hood is you're invested in thousands of different companies across the world with different business types and purposes. And that's what actually creates that diversification. Something really interesting in between 2000 and 2009, I mentioned that light blue category, which has really been leading the race. During that time period, US stocks return was close to 0% for almost 10 years. Over that same period, emerging markets averaged over 10% per year. And that's why we say that nobody truly knows it can forecast, time the markets, forecast what the economy is going to do. So we build your diversified portfolios and plan for times like market stress and uncertainty. We're going to continue to diversify your investments across thousands of different companies around the globe. One, to minimize risk, and two, to have sources to provide income for you in retirement during those tougher economic times. So really want to round things up with a good reminder for us today. Successful investing is driven by the plan that we have built and created together. Failed investing is driven by what the market is doing. Thank you, Ken.
Thank you, Michael. Really appreciate your perspective on that. Always great information from you. Thank you so much on that. I just want to talk on one thing here before I hand it over to Ashley's acumen on the financials. Her name changes, I think, weekly. We're not sure what it is yet, but we'll come up with something that sticks one of these times. So I want to talk a little bit about account diversification and the bucketing approach, just quickly, but importantly, it's really important. Account diversification. We talk about investment diversification quite a bit. That gets talked about a lot in the media. It gets talked about with amongst people, right? Quite a bit. But account diversification doesn't. And that's like step 2 of the process. Once we are saving money, once we have a great portfolio, where does it go? And so when you talk about like different buckets almost, like, you talk about a pre-tax account where we get a tax deduction today for money we put into either an IRA or a 401k or a 403b, something like that. Then you have what we call post-tax money. And a lot of you know it as like, a Roth IRA. That can be done in a 401k these days as well. But money that's being invested after tax in a retirement account, that's the second bucket. Then all of a sudden you put in what we call a personal bucket or a trust account. Sometimes those get retitled, like when we do our estate planning, those personal accounts turn into trust accounts. That's what happens there, right? But those are kind of taxed as we go, if you will. So not only do we have investment diversification, now we have account diversification, and it matters because it has a lot to do with flexibility of money, when we can use money, what we can use money for, what age we can use it, and then also at the end of it, it comes down to tax planning. It's not really what you make, it's what you keep in your pocket, and you're able to spend it on things that you really enjoy doing in life. And that's where the account diversification comes in so nicely. And the earlier someone works with an advisor like ourselves, the earlier we can get started on this account diversification idea. When we're really close to retirement, it's a little harder, it's a little more difficult. In retirement, we try to do it through Roth conversion planning, which is creating another bucket, right? Through tax planning and things of that nature. But someone who's in their 20s, 30s, 40s, 50s, like this is the time to start talking about account diversification as well. The other piece I want to touch on is the bucketing approach. This one's really important when we talk about retirees. If someone's thinking about retiring in the next 3 to 5 years, if you will, this is where it comes into play so nicely. A lot of times we get the question, well, what really changes for retirement and what changes for my retirement strategies? A lot changes because we go from this accumulation phase, which we're trying to get the most growth out of our money. And in retirement's no different. We still need that growth, but we need a really, really key component, which is called income, which is called a paycheck. We need to send you a paycheck when you retire to replace what you just, left. You left your job for a great paying paycheck. We need to replace that. How do we do it? We do it with a bucketing approach. So to make this really simple, like 1 to 2 years is cash. That's different than when we're accumulating money because now we need to distribute money. It's the second half of the game. This is a really important phase. So we have this 1 to 2 years of cash built in, whether it's, through a money market fund, whether it's through CDs, there's different various approaches to this and different strategies, but that's bucket one. Bucket two are going to be our bonds. This is our 3 to 6 year bucket, if you will. Again, Zach mentioned it really nicely today that bonds are holding up during this time frame of uneasiness in the market. That's the whole point. That's why we do that for you. That's that 3 to 6 year bucket for you. So again, income has already been thought about for the next 6 or 7 years for a lot of our retirees. And if you're getting ready to retire, that's what we're shifting to. That's what we're going to give you that security and to give you that that income need that you need when we think about retirement. And the last bucket, of course, is what you may think about. It's our longer term investments. So it's our growth investments. It's the great companies that we invest in. That's really our 7 to 30 or 40 or 50 year type of bucket where we know over time great companies are going to give us that growth that we're looking for. So that's really the bucketing approach. It's really important. And it's really a timely thing to talk about at this point in time as well for this one. So with that being said, I would like to toss it over to Ashley's acumen on the financials. Ashley, what do you have for us?
Thank you, Ken. Both Zach and Ken have already hit on my topics today, but I just wanted to elaborate and show you a visual very quickly to explain some different ways of looking at saving your money. Some of the low risk options that you are able to save money yet also grow your money include a high yield savings account. This is an account that interest as well as safety is something that is high at the top of the list. Certificates of deposit, also known as CDs, probably see them at your bank advertised. This is also an alternative or an option here at Raymond James, along with that high yield savings account. So again, please feel free to reach out to anyone on our team to help you with some options for some savings options that are very low risk. Treasury bills, also touched on already, but they're a short-term government security and it has moderate returns, but it's also backed by the US government. So we know that they are a safe option for you. A savings bonds is also something that you constantly hear of. It's another low risk savings option. So again, a lot of these options can be done here at Raymond James or of course at your banks if you're wanting to keep it local to yourself. So again, reach out to any team member. We're happy to help and just wanted to show you a visual of some low risk savings options. Thank you, Ken. Back to you.
Thank you, Ashley. Really appreciate that. And that fits really nicely into that bucket one we talked about, those cash needs. There's so many different ways we can do the cash needs. And thank you, Ashley, for bringing up and showing those visuals on what those could possibly be. And so every scenario is a little different. That's why we have to tweak it to your needs and your likings and your preferences sometimes. A lot of times you look to us and say, hey, what's best? And so these are the areas that we'll identify those cash needs in for you there as well. So thank you, Ashley. Appreciate that very much. And we have a birthday club today, and Ben's going to talk about some happenings right now. And I heard this one recently, and I thought it was really important, and I just wanted to bring it up. So that Chris has talked about the birthday club and kind of changing our script on how we maybe ask somebody or maybe what we say about the whole how old we are. Remember, we changed that to how long have you lived? How many times have you called somebody and said happy birthday to them, and they actually said, well, yeah, it's just another year. And like it's a modest thing to say. It's a I don't want the spotlight thing to say. I don't want the attention, on me, right? It's a very normal thing that a lot of humans do. Imagine if you called somebody and said happy birthday and they said, wow, thank you so much. I'm so grateful. I get another year to spend with you. Like, wouldn't that change like how that message is being received and given back to each other? Wow, like imagine if you even personalize it. Imagine you say, wow, I'm so grateful. Thank you for your phone call. You know what? I get another chance to do a Brewers game with you. I get another chance to cook out with you. I get another chance to take that weekend getaway with you. Wow, it makes people feel special rather than just saying, yeah, it's another year. As we get older, I'm going to be 45 this year, so I get to pontificate a little bit on some perspective here, right? So I'm starting to earn that a little bit, earn that right a little bit, not so much, but a little bit. But a lot of people around me are getting sick, and they're 70, they're 60, they're 50, they're 40. Like, you never know how many more years we really get in all this, right? We save money for 30 years to hope to get that retirement. Guess what? Some people do get the retirement, and that is a lucky, blessed event in our lives. And some people don't. So maybe changing the script on how you answer that question, be like, wow, thank you for your phone call. I'm so grateful for you. Really appreciate that. Looking forward to something coming up with you, right? So anyways, thought I'd offer that. I heard that one recently. I thought it was a good one to share with you all. Last but not least, Mr. Ben Renicky, can you tell us what's happening here at Gentian with the happenings, please?
Love to, Ken. Thanks for passing over. Yep, there's plenty going on here at Gentian as always, and that's all thanks to you guys as our clients. We wouldn't be able to do all these wonderful things without you. And Ken hit it on the spot with the very first thing is today we get to celebrate our April birthday club. So doors open at noon, and as Ken said, he had the perfect lead, and it's not how old you are, it's how long you've lived. So we do these every month. So keep an eye out for May. So if you got a May birthday, kind of keep in the back of your mind that, hey, we'd love to have you join us here at Gentian to celebrate how long have you lived. Next thing is to keep in mind is Good Friday. We are closed. Our offices will be closed as well as the markets for this Friday. So please have a happy Easter with you and your family. Next thing is April 22nd, Tuesday. We have our volunteer day at the Domes. So we are full right now, but we just wanted to say thank you to all our volunteers that have given their time to help us give back and actually practice what we preach of the planet, live it, and give it part. So thank you to you guys who all volunteered to help us out with that. Following that up with the next day, again, April 23rd is our Spring Technology Summit. So that'll be Chris went out to Abundance 360, and he's got a ton of different things that he wants to share with us of what's coming down the pipeline. So I think it'll be a really great opportunity for you to learn more about what's coming in the future and not so distant future either. So please come join us. However, that is an RSVP is required, and the final day to RSVP for that is today. So if you can join us, please let us know. We would love to have you be a part of it. We also have then our normal bi-weekly podcast. That is going to be happening in 2 weeks from now. The next one will be April 30th, Wednesday, again, still at 9 Central Time. Topic that one is going to be emergency savings and what's the required amount, or recommended amount, I should say. Not required, recommended. But we're not going to give you that now. You're going to have to come back and check us out here in 2 weeks to get what that number is. So please check that out. And then last but not least is another kind of unique special thing that we get to do is we're having a day trip to Fireside Theater. So please join us and your friends to see a theater showing of Murder on the Orient Express. There is a cost associated with $123 per person, but that includes transportation costs. There'll be a bus that you'll be taking as a group down there. It includes a delicious meal and also the show and getting you back on time. So we'd love to have you join a part of that. We do have a few select seats left, so please let us know. If you have other questions, please reach out to Ashley. She'll be able to guide you in whatever direction you might need. So with that, Ken, we got plenty going on at Gentian, but we look, again, as I said, we couldn't do this without you guys, our clients. So thank you all. So back to you, Ken.
Thank you, Ben. Really appreciate that great summary of all the events going on. Thank you for the team for putting all those together so our clients get to experience those. We want to thank that the team that puts those together. So I want to thank you for your time. We went over 5 minutes today. We appreciate you sticking with us. Thank you so much. We really thought that this was really an important podcast today to really talk about diversification, risk versus reward, and other things that went along with it. So thank you very much for sticking with us. Thank you for being our clients. We appreciate you. Without you, we don't get to do this, and we love doing this for you. We really do. Our team is excited. It's full of vigor every day, and we look forward to meeting you the next time we do. And from, like Chris would say, from our galactic headquarters here in Mequon, Wisconsin, we want to thank you very much. And also thank you for the introductions you give to us of the people that you care most about in your life. friends, family, neighbors, coworkers. You know who they are. We thank you for that. It really helps us grow here at Gentian and provide even bigger and more services for you as well. So thank you very much. Thanks for tuning in. Have a great day, everybody. Bye now.